Hi Sanchi, we are on live now, so just wait for. I able to unmute? Just letting other.
Yeah. Yeah.
Oh, got
All
you.
good.
Okay,
Yep.
perfect.
Has anybody joined yet?
Just making sure we're just letting others join. So
Okay. Yeah. All
we
good.
have like 5 minutes.
Yeah. Okay.
We're almost on time. We have got another 1 more minute to go. And in the meantime, we'll just try and let others join. All right. Now, 6 o'clock. Let's start the webinar. And if you can just put a thumbs up or something, whether you can hear me, you can see me. Okay, that's good. Great news. Thank you so much. Let's start now. Good evening, everyone. Welcome to today's sessions on tax and wealth strategies for doctors. Tonight, we are focusing on structuring property investments and Indian assets, all within the broader lens of financial planning. Our goal is to address the areas that matters most to doctors, both professionally and personally. When it comes to managing wealth and minimizing risk, that is exactly we are trying to address all those points there. So I'm Satya Hegde, a chartered accountant and a CPA, and I specialize in tax planning for medical professionals. I help doctors navigate complex tax regulations, stay compliant, and structure their finances in a way that supports a long-term wealth creation. Our firm is based in Sydney, and we work with medical clients across Australia. So I'll begin with tax-related strategies and structures, which I'll be covering over next 20 minutes. Following that, Sanchi, a chartered accountant and financial planner for 10 years plus experience with a CFA, and she's part of the way to Wealth, and will guide you through the financial planning insights for another 20 minutes. Sanchi? Yeah.
Hello, everyone.
Yeah, thank you, Sanchi. We'll wrap it up with a Q&A led by Raghu Wattam. Raghu doesn't need introductions, but anyway, so he's a lead financial planner at Way to Wealth, and he's happy to answer any of your difficult questions. So now you know, ask easy questions to me and difficult questions to Raghu.
Thanks, Satya.
Yeah. We call Raghu the money man. So please ask him how to make money. So he's the one who is going to answer.
Thanks, Satya.
All right. Okay. Now, quick disclaimer: this presentation is intended for information purposes only. Does not constitute tax or a legal advice. Please speak to your accountant, legal advisors for a specific guided tailored to your situation. So please be mindful of that. And I will just move towards the first important slide. Okay. So what are the key challenges for doctors? Doctors often face high tax liabilities, increase in clinical demands. It's a common to see issues around non-compliances and cash flow issues. Poor structuring is added to that complexity. On top of that, what we have is an asset protection becomes very critical, especially given the risk associated with the profession, and the need to preserve the wealth. And no need to mention about family time there. So absolutely critical, absolutely smashed. So we are just trying to understand those areas. So let's get into the basics of understanding PSI versus PSB. What is PSI? Personal service income. Income derived from your personal efforts and skills and expertise. And just to make it easy to understand, those who are in a PAYG, locum, or VMO, or a part-time employment can be classified straight away as a PSIs. There is no ambiguity as such. And of course, I'm just making it simple for you. So there are other, and I don't want to use all the legal jargons here. So what happens if you are under PSI? You will be taxed at a highest marginal tax rate. no income splitting allowed, and deductions for related party transactions are not permitted. So in short, you'll be paying highest marginal tax in the PSI scenario. What happens with the PSB? PSB is a personal service business, which is a legitimate business which meets the ATO test. Just like a medical field, ATO also has come up with a test for personal service business. Result test, unrelated client test, employment test, and business premises test. I would not like to, I don't want to get in details about all these tests. All I'm trying to say is that if you meet all those tests, you will be classified as a PSB. And once if you become a PSB, what happens, you will have a better tax structuring, which will have a better tax outcome as well. So that is exactly we are trying to understand. Just to give you an example, if you are in GP practice, or if you have an arrangement with a GP setup where you're sharing 30% as an admin fees and 70% as your fee, that is a classic example for PSB. So we just try to see that how you can classify yourself as a PSB in a proper business setup. So what happens once we classify you as a PSB? It's where the family trust structure comes into play. So I have another slide where we'll just explain about the risk factors. But so how family trust structure works, and I have a small diagram and I would like to share it with you. This looks really complex, but it's really a simple structure. If you want to have a family structure, what happens? You will have a medical service trust or is led by a trustee company, and multiple partners can become a practice owners, and whatever the sharing combination which you want to have, those things can be considered. What are the risks associated with the family trust and why the family trust has become so important? That is what we are going to look at it later point of time. And once you are in that area, so high profit retention in trust, okay, triggers a tax avoidance scrutiny, which you should balance it in such a way that you are under the PSB. At the same time, you are not taking undue advantage of a tax issues here, right? Income distributed to the non-active family members can become really difficult here, and the compliances with the trust is another issue which we need to address. Now, why this structuring and why the family trust, which we are talking about under the PSB, the personal service business, is a major change which has happened in 2022. In 2022, the doctors' taxation has undergone a massive change. There is a new draft which has come in 2024 that also gives kind of an indications where the ATO is heading towards. But we are not going to discuss about draft rules because it is not passed in the parliament. The election is due, so let's leave that aside. Now, if you haven't changed your tax planning and tax structuring in the last 2 years, after this major 2022 changes, maybe this is the time where you should be looking at it, because ATO is increasingly looking at service arrangements and some income diversions and profit sharing. You need to be compliant, and at the same time, you should be structuring it to save some taxes. If you have any questions, if you have any clarification, if you have any, issues which is bothering you, please just put it in your chat box. What we will do, we will take it up at the end and try and answer them as much as possible. So Asset protection is something Sanchi is going to discuss in detail. So what I have done is why asset protection and Indian investments becomes major point here. That if you have all of us have a primary residence in our individual's name. The reason being very simple: 100% capital gains exemption, and that is a major reason we have primary residence in our name. But is it make sense to own a primary residence in the high risk profession spouse, or whether we should hold a primary residence in a relatively lower risk spouse? So that is a question which we are asking. So if you have already done that, there are different ways in which the lawyers look at um, gift and loan back strategies. So which something our financial planning team can discuss. Then the second important observation which we are looking at is a negatively geared investment properties. So negatively geared investment properties gives you a negative gear if you are holding it in your personal name. What happens to the asset protection of that investment property? If something happens, you always, the doctors have like two types of risk. One is a patient doctor risk, which is always managed through your insurance, indemnity insurance. There is another risk, which is a financial risk, which we are trying to mitigate here. So if you're taking a money as a sole trader and you exposed to the second risk of a financial risk, which we are trying to bring a family trust or any other structure in between, so to protect you from your financial risk as such. So investment properties also, under a family trust, there is no negative gearing benefits, but there is an asset protection. That is something which you need to look at it in a holistic view. Sometimes a negative gearing doesn't last even 5 years. Then the property is going to be with you for 20 years. So does it make sense? So once it is become positively geared, then you'll be paying around 50% tax there. So that is something you can look at it. The same issues with the Indian properties as well. If you own any Indian properties or you are inherited any Indian properties, the same rules applies. There is a lot of structuring required for the Indian properties because the property is outside Australian tax jurisdiction. So I am sure that you know that if you generate any rental income in India or in UK, you need to disclose those rental income in Australian tax return. So whether you pay tax in India or UK, it doesn't matter. You need to disclose the entire global income in the Australian tax return. The good news is that there is a foreign tax credit rules. So if you have paid any taxes in any respective countries, then you can claim that as an exemption here. So it's not all the bad news, but it is a compliance requirement that you need to disclose all those information. And when you want to sell your properties in India, there is a capital gain tax in India. So you pay a capital gain tax in India. Then whether you repatriate that funds back to Australia or not, still that is taxable in India, in Australia. But however, then there is a foreign tax exemptions available, so you can claim that taxes paid in India here with the Australian tax office. So there are some strategies available if you're planning to sell your properties in India, and the timing of sale is also very important. Then you can bring that funds to Australia in a safe, compliant way. Then with a minimum tax exposure there. I'm just trying to summarize what we have discussed so far. These are the common mistakes which doctors do: the misclassification of PSI and PSB, thinking that the PSB, but it could be a PSI. So that is something you need to revisit, especially after 2022. not claiming the foreign tax credit. So whatever taxes which you paid and whatever income which you have outside Australia needs to be disclosed here. And fund transfers, either fund transfers from India to Australia, or you're transferring your funds to your parents for maintenance or anything else. So then there is a gift tax issues with respect to the international fund transfer. Please make sure that you disclose these informations in properly. So the property sale, which we have already discussed, there is a capital gain tax in India. There's a capital gain tax in Australia for the Indian properties as well. So that is something which you need to be mindful of. So there is another interesting changes which has arisen now with payroll taxes in NSW and Queensland. And if you are doing 30/70 sharing with the practice, there are many practice owners in the same practice. You may come under the payroll tax, which is about 5% plus now. So make sure that you are within the threshold limits. So the rural threshold limits for the bulk billing is different. Maybe you should not fall under the payroll tax. That is something you can discuss with your practice admin about the payroll tax issues. So that has become a really big problem now. So the last one which we want to discuss is the EV cars and the FBT exemption. If you're planning to buy a car, and as you may know that you can use it only for the business purposes. But if you buy a EV electric vehicle, and you can claim 100% of an exemptions, even though it is used partly for a business, partly for personal. Both are allowed for tax purposes. 100% you can claim. But the only catch here is that if you are a sole trader and you can't claim the EV car, but that's why the structure is very important. Then if you are in a family trust or the PTY limited, that is where you can claim the EV 100%, even it is personal expenses. That saves around $7,000, $6,000, $7,000 every year at this point of time, with tax benefits and everything. So it's a really good case to have a structure and buy a EV car if you're planning to buy one. So hybrid car was allowed till 31st of March. That has been removed now. So there's a bit of a to-do list when it comes to Indian taxes in Indian properties. Please disclose that you have a property. If you have a property outside Australia, please disclose it in the tax return. There's a clause 20. So make sure, let your tax agent know that you have properties outside Australia so that they disclose it for you. And in India, you can't have a savings account. You have to convert all those accounts into an NRO accounts, and also check tax records and find out, is there any old tax notices or demands sitting there, and making sure that they have been addressed properly. And disclose Indian income in your Australian tax return. And if you have a PAN and Aadhaar linking and all those drama going on at this point of time, that is something which you need to be aware of. So what services, what we are offering, we do a tax structuring and restructuring. And if you need some bit of restructuring for your existing structure, happy to address those. And we have a bookkeeping and compliances for the medical professional, and navigating locum for that matter, right? Whether it is coming under the PSI, PSB rules, or in case of a VMO, whether it is makes sense to connect the super there. VMO can some of the practices offers a super, and whether it makes sense to get the super, or whether you have to get it to the family trust. So that is something which we always discuss with our clients. Payroll and GST issues. So that's a big ticket items, and Indian property structuring and disclosure. We do a very proactive tax planning, so to avoid a last-minute rush and not even bothered about the super and other things which I'm not covering here. So Sanchi is going to cover those items. And fractional CFO support, looking at your billing, trying to see whether you have done all of that, and just happy to look at those numbers and run by it. So if you have any tax issues and which is affecting you, please type it in the chat box, and we will happy to address those. And we have like half an hour free consultations for anyone who wants to discuss with us in detail. Thank you once again. That's our team is going to share the details with you, and you can reach out to us if you need any help from us. Thanks once again. Sanchi is going to present her financial planning side of it. Sanchi?
Thank you so much, Satya. I'll take over from here. Hello, everyone. I just discussed about the wealth strategies for doctors with regards to financial planning. So just give me a minute. Okay. So I would like to start off with a disclaimer. Everything that we discuss during this entire session is just general information, and please do not consider it as a personal advice. It's not a one-size-fits-all solution. For a personal advice, for a genuine personal advice, it's always better to seek a personal session and get to know what's best in your situation. So these are the topics that we will be covering today, and please feel free to ask any questions in the chat box or in the Q&A box. So to start off with, we'll just talk about the asset protection strategies. Like Satya already mentioned in his session, that there are different ways where you can own a property or any asset. And it's very common that we own our primary residence in either single name, individual name, or as a joint tenant. There's also something called as tenancy in common. I just want to explain the difference between the two. As a joint tenant, if one of the person passes, if you own a property in a joint tenant, and if one of the person passes away, then the property automatically goes on to the other joint owner. Whereas in tenancy in common, percentages of the ownership percentages are crystallized, which means if one of the person passes away, the ownership of that property or that asset has to go through wills to pass on to the future generations or to any other person. And then there are family trust, where again we can own the assets. And family trust is from an asset protection point of view, it's a very good strategy to own a particular asset in the family trust. Again, it depends upon individual circumstances. For a primary residence, it's not usually a case we see that people owning primary residence within family trust. You can own it though in certain states. With regards to investment properties, it is a good idea from an asset protection point of view to own properties under family trust, but it comes with its own caveats, which is land tax implications, depending upon which state you're buying into, and then again, not receiving the negative gearing impact. But with regards to any properties or specifically primary residence, if you have it or you own it in your personal name, there is something called as gifting and loan back strategy, which can be used specifically in your cases as being a doctor. It's a very high risk profession. So we don't want to own too much assets in our own personal name. So what can be done is, like, I'll just give you an example. If there's $1 million worth of property and there is, say, $600,000 worth of loan on there, there is $400,000 of assets sitting in your name. So that can be gifted to the family trust, and the family trust can give the loan back. So that way we can, so there's just loan in your name and then there is no asset in your name. It's a bit of a tricky or a complicated strategy, which we take help of a tax lawyer to get into these strategies. The main idea is to avoid having any asset in your name if you're in a high risk profession. So this is with regards to asset protection. And Satya already discussed about the benefits of family trust or discretionary trust, mainly used for asset protection and also wealth creation in a more tax effective way. If you are planning to create wealth in a long term scenario, it's very good to use family trust structure. But again, it depends upon individual situation. Not to everybody a family trust suits, but it is a very good or a very tax efficient structure. One thing we need to make sure of that the income earned by the family trust has to be distributed every year. If not distributed, then it is taxed at a highest marginal tax rate of 47%. And there's a lot of flexibility about each year whom we want to distribute the income that can be decided as and when the years pass by. So that's with the asset protection. Next, we'll move to cash flow and budgeting. So, like in medical profession, we say that if a doctor is giving you any medication or anything, they need to know what is the ongoing concern or what is the underlying cause for that. So, same goes with budgeting. If we want to do budgeting for our personal situation, we need to know where the money is going. So that is a most important part here. And certainly we are very busy and our lives are pretty tight scheduled. So we can make use of budgeting apps to stay on track and make sure and see where what's your spending pattern. And ideal is to keep your personal and business cash flows separate because I'm aware or I'm sure that a lot of people might be working on a contract basis or having their own businesses. So it can be a lot of confusion if we just mix them all together. So it's ideal to keep them separate because sometimes the taxes can be delayed or the taxes may be paid a later period of time. So it's best to keep them separate and create or set a spending target. The most important thing I will say is make savings and investment as a non-negotiable expense. Don't treat it something as if after the expenses, if I have something left, then I will save. No, it should be a non-negotiable expense. That's where there are more chances that you can do the savings. And also, like you can use strategies like salary packaging, whether it is like um, uh, whether it's like a super contribution, salary sacrifice that you do. Salary sacrifice can be like a forced savings that can go into your super without you even knowing about it. So that is some tax efficient strategies that you can use. And you can make use of an offset account against your primary residence loan. Like there are strategies that we can do if you have a good chunk of balance in your offset account. We can restructure the loans along with the help of a mortgage broker in such a way that we can reduce your cash flow burden and improve your cash flow. You have more cash flow in your hand to make use for your daily livings. And always have emergency funds. Like it shouldn't be a situation that if an emergency suddenly pops up, you are digging into your savings or you're digging into your business cash flow or your personal cash flow. You should always have some funds aside for a rainy day. Ideally is to have like around 6 months of your living expenses aside for a rainy day fund. The next is superannuation and retirement planning. I'm sure you might have all heard of superannuation. It's a very common structure, or it's a very common environment, obviously, where we use or we accumulate money to help us for our retirement. It's just where we are saving and investing money for having a comfortable lifestyle in retirement. So there are two phases to understand here. Accumulation phase, where you are accumulating money into the superannuation as in where you are contributing into the superannuation. So the key things that I want to explain here is the concessional contributions, which is can be the employer who's contributing into your super, or you can also contribute into your super, are taxed at 15%. Or if your income is about $250,000, then it is taxed at 30%. And any earnings within super are only taxed at 15%, and long-term capital gains is taxed at 10%. This is during your accumulation phase. And then next big question is, when can you access your super? So there are three major dates that I want you guys to remember, which is like 60, 65, and 67. 60 is when you can access your super, but depends on what your work status is like. It can be partially accessed or fully accessed. And age 65 is when you can fully access your super regardless of your work situation. And age 67 is when you become eligible for age pension from the government, provided you meet the requirements. Now, next is the last part is the pension phase or retirement phase, where when you decide to retire and you're past that either of the two ages. So no tax is paid during your retirement phase, either on an investment income or on capital gains tax. So that's a pretty good deal to have. Another important aspect is franking credit refunds. So what happens is the Australian companies, if you invest into Australian companies, they pay 30% tax beforehand before giving any distributions to you. So let's take an example that a company, Australian company, did make a profit of say $100. So they, on your behalf, they will pay $30 to ATO and then distribute you $70. But when you're into retirement phase, your tax rate is just 0%, right? So that $70 that you get, you were also supposed to get the $30 back. That's what called as franking credit refunds. ATO will refund that $30 to you because you are not supposed to pay any taxes. So that makes your income $100. So that enhances your income during pension phase if you have invested into Australian companies. And now the next important question is, how can we boost superannuation? So the first thing is definitely start early. Even if you're starting small, if you give a big, like a large amount of time for your superannuation to work or for the compounding to work, it can make huge difference. So start early, and you can maximize your superannuation contributions. You can, from this financial year, you can contribute $30,000 every year, including what your employer is contributing. You can make salary sacrifice or personal contributions over and above your employer. Make sure it fits within the $30,000 cap. And you can utilize something called as carry forward concessional contributions. You can check this information on your ATO website. You can go to Super Manager Super and carry forward concessional contributions. You can see if you have any cap available. So what this means is, in last 5 years, if you haven't utilized your concessional contributions limit fully, you can utilize in 1 year or a combination of years, if provided your balance is $500,000 or less. Um, so that can boost up your super balance. And you can also do something called a spouse contribution. To, if your spouse is earning less than $40,000 in a particular financial year, you can contribute up to $3,000 or more and receive a tax offset of $540. So reduce your taxes and boost superannuation for your wife or your spouse. Another point is, always review where your super is invested. It's very common that we have seen among our clients as well that people don't take a look at where their money is invested. It could be a huge amount of money, like hundred thousands or more than that, and then they don't even check that where their funds are invested. So it's important to have a look. Where is it invested? Is it invested as per the right risk profile which you would prefer or not? As simple as a 2% difference in an investment return can make 39% difference in 25 years or 49% difference in 30 years. So just to give you a context, this is how it may look like. This is how broad it may look like as and when the years pass by. Because we are investing it for a very long period of time, so we need to be mindful of, or we need to be sure that our investments are correct. And you can always reach out to us if you want to make sure that if you're invested in a right place or not. And yeah, certainly maximize your super at different life stages. For example, if you do sell an investment property, there are ways where you can reduce your taxable income, and as at the same time you can even boost your superannuation. If there's something you are considering to downsize your home, you can at the same time look to even improve or boost your superannuation. So, yeah. I just want to cover the personal insurances aspect. There are four major types of personal insurances, which is life, TPD, total and permanent disability insurance, trauma insurance, and income protection insurance. Again, a part of asset protection. Just by we are trying to cover ourselves from the point of somebody sues us, but it is also important that life may take such unpredictable turns. So we need to be sure, and we need to make sure that from a health point of view, if something goes wrong, we do have appropriate insurances in place that can take care of you know our family or ourselves if we ever come into that situation. So there's just an interesting chart, which is the insurance need versus life cycle chart, which is just saying that how in different stages, what is the requirement of the insurances in different stages. So as in when we are early in our stages where we're just started our family and things like that, that's where the need for insurances is the most, because that's where we are the risk if something goes wrong to us, whether we are not there or whether if something goes wrong to us from a disability point of view, the risk is very high. We don't want our family to be, being on streets, or us to suffer if a disability happens during that stage. So insurances play a very crucial role in the initial years of your life. This is when you're just started the career, you're still building the wealth, probably you have a lot of loans as well, and as and when you move more and more towards retirement age, your wealth creation has been already been maximized, and you there are chances that you probably don't have any loans, or the loans are very less. So that is where our requirement for the insurances keeps going down. The ideal is to have appropriate levels of insurances when you're young and healthy, and you keep reducing it as and when your wealth gets accumulated. Okay. So just a brief summary about what each one of them means. So understanding is obviously one aspect, and then figuring out what is the right cover amount for each one of them is another one, which obviously you can reach out to us and then understand that what is the correct amount for you and your family. So life insurance pretty easy to understand. If one other person passes away or is being declared as terminally ill, that's when insurance company pays a lump sum cover amount. TPD insurance is when you're unable to ever work again due to sickness or injury, has to be a permanent disability. But by saying that, it doesn't mean that you have to be bedridden in order to get the TPD insurances. There are definitions which cover your specific job, and that's what we want specifically doctors to cover for. Because you're a high earning professional. So we need to make sure that if you're not able to do your specific job, you should be able to get the lump sum cover if at all you're unable to ever work again in that occupation. Then comes critical illness or trauma insurance. Again, it's one of the most claimable insurance out of all four, and it covers the listed medical condition. There are around 52 medical events. Can't name them all, but then just to give you an overview, it's mostly covers all sort of cancers, all sort of health issues, some of musculoskeletal issues as well, major surgeries. If you're in intensive care, again, each one of them has its own definitions, but broadly, around 60 to 80% of the claims happen because of cancer and heart-related issues. So again, a lump sum cover amount is paid in case of trauma, if the medical event happens. And then the fourth one is income protection insurance, which is pays you like a replacement of your salary, but obviously doesn't replace your salary fully. It can only replace up to 70% of your salary if you're unable to work or you're working at a reduced capacity because of any temporary or permanent illness. So, yeah, this is just an overview of the personal insurances, what they mean, how they are paid, and who it pays to, and what all would that we would prefer to cover it. I'm sure you guys might have insurances within your super, or sometimes even employers offer insurances. So why we think it probably may not be appropriate is you always need to check. First of all, you may have insurances, yes, but it may not be appropriate based on your personal situation or the loans that you have. And loans are not the only things that we want you to cover. There are other risks apart from loan as well that we want you to think and cover as well. And again, a very big myth that premiums or insurances through your super are always cheaper, which is actually not the case. Often we think it is cheaper because the sum insured itself is very low. That's why the premium looks very low. But it's not the case. You will be surprised to see that other, like the proper insurance companies, probably offer much better value. And there can be tax on the payouts in case of, say, TPD and income protection as well if you own it through super. And there are no claim services offered by, if any of those companies, like if you buy from employer or from super, if you own insurances through them. And you have to be very careful. The covers may lapse, or you may risk of losing the covers if you change your insurances or if the contributions are not happening on a regular basis. So that's very important to check. And a very important point I want to cover is that it is not guaranteed renewable, which means the features of the policies can change every year for that matter, and without even taking any consent from you. So that is a very big risk, I believe. And with a proper insurance company, it is always guaranteed renewable. That means your policies will not change for worse, it can only change for better. So the next part is estate planning. Estate planning is not just about a will. It is way more than a will. We need to ensure, or whoever is writing an estate needs to ensure that a right asset and a right information gets passed on to the right people. That's a very important part, and we want everybody to have a will and an estate plan so that we make like the lives of the people whom we leave behind easier. The These are the components of having a proper estate plan. There obviously needs to be a will where we need to direct that, how your assets are to be distributed. And unlike a very common misconception that your will has to be created only when you're later or older in your life, that doesn't have to be the case. It should be done as soon as possible, I believe. That's because anything can happen to anybody. We don't know when the time will be. And again, it covers the wordings used in a will are very generic, which means it is going to cover all the assets that you own right now or you will be owning in the future. So you can be like, sure of that and not worry that what will happen for the assets that you purchase in the future. And you need to have guardianship as well if you have minor children, to make sure who's going to take care of your children in case if you are not there anymore. And power of attorney, enduring power of attorney, you need to identify who's going to be the beneficiaries and who is going to be the executor of your estate, which means who's going to manage and carry out the wishes as per you wanted. These are some of the components, and how we come into picture is we can provide you guidance about what exactly needs to be done, and we do work with lawyers to help you secure the correct plan. This is what I talked about. These are attorney and guardian, and these are power of attorney and appointment of enduring guardianship. This is something which we need while we are alive. Attorney to make financial decisions on our behalf, and guardian to make medical decisions on our behalf if we are not in the state to make a medical decision. And this is executor, trustee, and appointer comes into effect after we pass away, where an executor makes sure that they are collecting all your assets and making sure how it will be utilized. And trustee is the one who controls the assets to make it or to use it for the benefit of the beneficiaries. An appointer has the power to change the trustee at any point if they are not comfortable or if they are not happy with them. Good. Thank you so much. And these are our contact details, and please feel free to ask any questions if you have. And I think I will leave it to you and Raghu, Satya. And Raghu?
Thank you,
Uh,
Satya.
thanks, Sanchi. Very nicely covered everything. So, Raghu, you would like to add some points on any area which you feel comfortable?
One thing I think probably Sanjay missed is beneficiary companies, making use of the beneficiary companies for which comes under within the family trust. Many people don't underestimate the power of beneficiary company, and that is where most of the assets can be kept, and then also we can have asset protection, as well as also we can generate franking credits through beneficiary companies. Obviously, like it depends on individual circumstances, where and when it can be used. But it is a great what's the word, asset protection as well as tax minimization strategy, which can be employed using beneficiary companies.
All right. Thanks, Raghu. You would like to discuss anything on the SMSF side of it, Raghu?
SMSF, we usually suggest people to go SMSF unless, like you're purchasing a clinic, especially in medical professionals situation. So if there is no clinic involved, like you can purchase a commercial property or a business real property is what we call, and that can be kept within the self-managed super fund, and then we can make use of a superannuation funds to purchase those properties. That can certainly work in a very tax effective way. Other than that, there are very few reasons to have a self-managed super fund, put it like that.
Yeah, yeah. Thank you very much. Anyone has any questions, put it in a chat box, and uh, otherwise, we can just cover other areas.
Looks like no questions, Satya. I'm very happy. So
That's, we both have presented so well that, everybody has understood what we were talking about. Alternatively, the chat box is not working.
is it not working?
No, it is working. It is. I'm just joking on that. Yeah.
And Anil, any questions?
Okay, I think so. Did somebody say anything?
Yeah, one question
Yeah.
has come. Where was that? Okay. When you guys mentioned doctor's job at risk job, is it around getting sued and financial liability that rise from the compensation? Yes, please, Bharat. It's more like if a patient files a case because of XYZ reasons, that's when it becomes a tricky situation. And most of the time, professional indemnity insurance do cover, but at the same time, professional indemnity insurances are also there to do business. So just because there is a claim doesn't mean that they will pay. So they will also try not to pay by searching various reasons. That's why we have to be one step ahead of the professional indemnity insurance. That's what I would say. And in my career, I have seen multiple cases where the doctor and then the hospital, though they're working for a hospital, they have paid together towards the compensation for the client. Forget about private practice. Private practice is very high risk, but I am talking about working in a hospital, like a public hospital, and along with the public doctor, they're together contributing towards like a compensation. I have seen cases, so it's very tricky. So better to protect our assets rather than getting exposed to unwanted or unnecessary risks like coming through patients, put it like that. That's what I would say.
Just to add two more points there. So as we discussed, there are two risks. One is a patient and a doctor risk that is covered by insurance. And what happens is that there's another risk, which is a financial risk, which means that if you are taking fees in your sole trader name, then the patient is also taken a consultations and he has paid you directly. So it's like multiple risk. So if you can eliminate the financial risk by having some kind of a structure where doctor and patient risk continues to be there, so which will be managed by insurance, but the financial risk is something which you can, they can't sue you for the financial benefits. They have to sue the structure. The structure can be a PTY Limited or the family trust sue, because they have paid the fees to those entities. So if I'm
There's yeah.
sorry,
There's
you
another
continue
question which
something.
has come. Raghu, for you
So,
probably. Can you
Bharat, I
say
think
one?
like, yeah,
Yeah.
so Bharat, I think you read it or you missed it, that one. Like, yeah, you can purchase a commercial real estate property and own a clinic like within the self-managed super fund. That's not a problem. It's called as a business real property is what we call. And then you can practice your like whatever like the medical practice is, and then it can be owned within the self-managed super fund. That's not a problem. And another thing is, Kesat Jain is saying we could only own the business if we have to construct the building. Could we use SMSF? The business cannot be owned within the SMSF. Like it's only the premises which can be owned within SMSF. And construction is again, it's a very tricky situation. That's why what we usually suggest is there are ways actually, especially in New South Wales, if you are in New South Wales, there are ways where we can have a clinic or a like a property in personal names or a joint names, husband and wife, and then do all the constructions in personal names, and then transfer it to a self-managed super fund with a very minimal stamp duty. That can be achieved if there is a construction involved, because construction is a bit tricky for a self-managed super fund, because under LRBA you cannot change the nature of the property. So the nature of the property has to remain similar. So there are strategies around that one, like that can be like applied if at all, if there is a construction or improvement to the property is involved.
Ask some difficult questions to Raghu, please. That's a personal favor I'm asking.
Does the EV FBT exemption work for public health employees? I would say so. I think it's a FBT exemption. So like you can use it through your FBT, this one, Satya, am I right?
Yes, yeah.
Yeah.
So the public health generally offers, EV FPD exemptions. So check with your, the contract, employment contract. If not, discuss with us. We can look at your employment contract and suggest you what needs to be done with respect to buying FPD. It's like 100% exemptions, even business travel, personal travel, both put together. Never happened before. So make use of this benefits, $6,000-7,000 every year. That is the average savings which is happening with the EV and FBT. Yep. Raghu, you would like to discuss about how anyone can help the kids to buy the first property.
Like obviously there can be some strategies it can be used. One of the thing is like first home super saver scheme. Like the doctors can themselves do some contributions on behalf of their kids and then access those monies. That's number one. And then there can be some guarantees which can be given to the kids. That's another thing. And or we can release some equity from the home, and then that can be loaned to the kids, and then they can go and then purchase the property as well. Another thing is we can also purchase properties in family trust. That's another thing, like where the beneficiaries will remain same, but it's only the ownership will be owned by the family trust. So there are different ways can be bought, but again depends on circumstances, and then what the parents as parents they are comfortable with, what structures. There are different structures, but parents should be comfortable with each structure. Put it like that.
All
So
right, thank you.
what advantage is disclosing Indian assets to
Yeah, I'll just
advantage of,
answer
yeah.
that. What is the advantage or a risk of disclosing Indian assets to ATO? Okay, so do we have a choice not disclosing it? We don't have a choice. So we got to disclose it. There are multiple reasons for that. One, Australian tax rule says that you need to disclose Indian income, Indian assets in the Australian tax returns. There are a lot of cases which has happened by non-disclosing. Then the second thing, there is a data matching that's you can just Google it and see there is automatic exchange of information system between India and Australian tax office. So pretty much whatever do you in India, that is getting passed on to the ATO, and they will compare it with your Australian tax return. If that information is not there, they reach out to you. So that has recently they have sent a lot of love letters for NRE deposits. So those who it is not taxable in India, so it is taxable here in Australia. So they have reached out everyone saying that okay, why it has not been disclosed. So we don't have any other choice but to disclose. And the other thing which I can say is when you decide to sell your property, then you say, you need to disclose it here or bring that funds here. Then the ATO will ask, okay, you never disclosed this information before, and how can you, have that now? So that these are a few, examples which I can share it with you.
And this is and money what that is transferred for family maintenance. That
Money
you
that
don't
is
need to
transferred.
disclose. Yeah.
You don't need to disclose the family maintenance side of it, but if you are planning to have a structure in place, that is something which definitely can be looked into, because family maintenance you're transferring is after tax, so that doesn't need to be disclosed. So the family maintenance is another factor which you can consider it for the tax planning purposes.
And one more thing, which of course Sanchi did say, but I want to emphasize again, is getting a testamentary trust will done. That is very, very important, especially for intergenerational wealth transfer. And most of the people will have simple will. That is, if something goes wrong, it goes to each other, and then with the testamentary trust, all the assets will go and sit in the testamentary trust, and it can only flow through kind of in bloodline only, so it cannot go beyond bloodline. Your son-in-laws or daughter-in-laws cannot access the funds. So that is what most of the solicitors say. So its ideal is to go for a testamentary trust will. It's a bit expensive, but like in a big scheme of things, it's not a big dollars, to be honest. Simple will is a nightmare. It will put everybody in a nightmare. So better to go for a testamentary trust. And there are a lot of lawyers in the game who does this one, but prefer to go for someone who does only testamentary trust. There are a lot of lawyers in the market who do conveyancing, litigation, separation, everything, but it's not worth going there. So you want to deal with someone who specializes with testamentary trust wills. It's a very specialized area, and we have a lot of very good contacts. We can help to get those things sorted. Purchase through earnings in Australia have been disclosed.
All right. So the assets purchased through earnings in Australia have to be disclosed. Answer is yes. I'm just trying to understand that you bought a property out of earnings from Australia but invested in India, so that needs to be disclosed as well. So there is no exemption as such. So
Other insurance policies bought in India. Insurance policies is a bit tricky, I think. But yeah, I think you can.
yes, insurance policy is like, okay, I'm just assuming. So, you have bought an insurance in India out of tax paid money out from Australian income. So, if that is the case, Indian policies are little complex. They are not like a straightforward insurance policies. Usually they comes with insurance policies and the investment packages both put together. So in such scenario, the insurance is obviously is that portion of insurance is always exempted, but the investment portion is considered for a taxation purpose. So any increment in the value of those investments which needs to be disclosed, and taxes needs to be paid. That's a bit of complexity there, because you don't know what is the mature value at that point of time, and you never see that money, then maybe 5 years down the line, 10 years down the line, you may get the money back. At that point of time, then the entire lump sum gets taxed in one go. That is something which you need to look into. So it depends on insurance to insurance, but happy to go through the insurance policies and discuss on that. But it is taxable in Australia, unfortunately.
As a general rule, the first thing you should, in case if you are thinking of purchasing insurance in India, along with investment, like in a package, the general rule is like we need to always ask for an internal rate of return, and most of the time internal rate of return is around 4% apparently, and it is not a good product at all. So better to check what exactly the internal rate of return you are getting on each and every insurance policy, before purchasing. That's number one. And another thing is with mutual funds, Satya, there are a lot of people who invest in SIP, systematic investment plans in India, and they ask this question quite often. I got overseas investments and then it doesn't earn any money. The whatever money it earns, it will be reinvested. Should I disclose? The answer is yes, because the income you earn out of a mutual fund is a distribution, and that is income, and it must be disclosed, here in Australia, though it is not coming into your pocket and though it is reinvested back into the mutual fund.
All right. Thanks for the clarifications, Raghu. Thank you very much. If you have any further questions, let us know. Otherwise, we can wrap it up. Okay. Thank you so much. Thanks for attending this webinar, and see you soon with other topics as such. EVs and other very important topics which you would like to cover along with Raghu and Sanchi. We will keep you posted, and I'll request our team to share the recordings if possible in 1 or 2 days time. Then we'll see you later. Thank you so much. Good night, everyone.
Thank you.
Thank you, people. Thanks a lot. Thank you.
Bye.